Hey guys, and welcome back to yet another video in the 365 Days of Forex series. In today's video, I'll be discussing why we look for long wick rejections at levels within the market, and what these long wick rejections actually mean in terms of buyers and sellers. Because, as some people may say to you, size really does matter when it comes to rejections from levels. So without further ado, let's get into today's video. Long wick candles can be called many things, such as long wick rejections, pin bars, hammers, and many more. The important thing is that we can recognise them, as well as understand the intuition behind them. Let's now take a look at them in a bit more detail. Long wick candles are exactly what the name suggests. It is a candle that you might find at level structure that, if you hadn't already guessed, has a long wick. These candles preferably have a small body, but beware that they might actually not always have a small body, and are generally seen as a reversal candle following the rejection of an area. A good rule of thumb is that the ratio of size of body to the size of wick should be around 1:3, if not 1:4 as a minimum. Essentially, we're looking for candles that fit the criteria of pin bars. So in order for us to truly understand long wick rejections and why they're important, it's vital to know what has actually happened within the market dynamics of the market to create this long wick rejection that prints on the chart. In the most part, the long wick rejection is formed as a direct result of supply and demand. For example, if we're looking at price action and price is approaching a previous key level of support in the market, price may form a long wick rejection, indicating that buyers have deemed the price to be too low towards the bottom end of the candle. The reverse is true for a long wick rejection at level resistance, as sellers have clearly deemed the price to be too high towards the top end of the candle. A long wick rejection can also be related to order flow and how institutional traders may be entering the market, as traders who went short early have had too tight stops and have thus been stopped out. This is because when your stop loss order is triggered on a sell trade, you need to buy back your position from the market, and this therefore creates a lot of liquidity for sellers, allowing larger traders to get big orders away in the market, forcing the candle to retrace and close below the resistance. When this aggressive move to the downside happens, it'll often leave a large wick, forming the long wick rejection. If you have a really long wick, then it's usually a sign that the rejection was substantial and price will struggle to break through that level in the near future. However, this does not mean that price still can't break through the level, and that is why we need to combine this price action with many other confluence factors. Let's take a look at these scenarios in a bit more detail.
As you can see from our example, the market gapped down on Sunday evening, which is then followed by a large sell-off in GBPUSD. As you watch price descend, we notice a long wick candle around the 10 AM mark on the 21st. If we apply the intuition of what we've just learned, price opened up here, price pushed down, but then it was deemed too low, and hence sharp demand forced the price back up closer towards the opening price. If we then continue with our replay, we can see that this mentality was shared in the later periods, as price continued sharply away from this level.
Now let's combine the long wick rejections that we've discussed today with what we learned in our last episode, multiple rejections of an area. As viewers who have watched both videos will have guessed, multiple long wick rejections are one of, if not the strongest indication of an area of structure being rejected. Combining the intuition behind both multiple rejections and long wick rejections, prices have repeatedly tried to breach this area and has failed. And this failure has been substantial as the area was strongly rejected. As a result of this, price is very likely to move away from this area and probably quite violently. One of my favourite ways of utilising this idea is with pullbacks of a trend. For example, if we're in a sustained uptrend and the multiple long wick rejections occur at level support, this is a great trade idea as price is likely to reject this area and continue in line with the dominant trend. Multiple long wick rejections are usually used in a trading strategy alongside the Fibonacci retracement tool, as they work really well in a confluence together. Let's now take a look at these examples over on TradingView.
As you can see in our example, between 2 AM and 7 AM, we have multiple long wick rejections of a previous level of structure. Applying our intuition from earlier, all we are seeing here is a level being tested multiple times. Buyers deeming that price is too low, and then entering the market to force price to push back up and close around the entry. This is a classic example of rejection of an area, and multiple long wick rejections are a great thing to understand and utilise in a trading strategy.
That's about all we're going to cover in today's video, guys, and if you liked today's video, then be sure to check out the rest of the videos in the 365 Days of Forex series, as I can almost guarantee you'll like those too. As well as that, remember to hit that like and subscribe button, as it really helps this channel grow, and well, we're really grateful when you do that. So without further ado, guys, I will see you in the next one.